மார்க்கெட்டோட நிலவரம் மேல போகும் கீழே வரும். இந்த ட்ரெண்ட் எல்லாம் பார்த்து ஆசைப்படாதீங்க. கொஞ்சம் கொஞ்சமா நீங்க பண்ணுங்க இன்வெஸ்ட். கனவு எல்லாம் நினைவாக்குங்க, இதுதான் பெஸ்ட். ஸ்மார்ட் மற்றும் சிம்பிள் philosophy. ஸ்மார்ட் மக்களுக்கு இதுதான் ஐடென்டிட்டி. டெஸ்ட் பண்ணு நீ, ஸ்டார்ட் பண்ணு நீ. சிஸ்டமேட்டிக் இன்வெஸ்ட்மெண்ட் பிளான்ஸ் அண்ணா சொல்றத கேளுங்க. அண்ணா ஸ்மார்ட் ஆகுங்க. ஸ்மார்ட்டா வேலை பண்ணு, SIP ஸ்டார்ட் பண்ணு. ஸ்மார்ட்டா வேலை பண்ணு, SIP ஸ்டார்ட் பண்ணு. பண்ணனுமா 350cc சவாரி, இல்ல செகண்ட் ஹனிமூன்ல ஆப்பிரிக்கன் சஃபாரி. கட்டணுமா ட்ரீம் ஹோம் இன் டவுன் பேமெண்ட், இல்ல செக்யூர் பண்ணணுமா ராக்கிங் ரிட்டையர்மெண்ட். பிளான் பண்ணணுமா உங்க ஃபாரின் ட்ரிப். நான் செய்ய வேண்டியது ஸ்டார்ட் சிப். ஸ்மார்ட்டா வேலை பண்ணு, SIP ஸ்டார்ட் பண்ணு. ஸ்மார்ட்டா வேலை பண்ணு, SIP ஸ்டார்ட் பண்ணு. ஸ்மார்ட்டா வேலை பண்ணு, SIP ஸ்டார்ட் பண்ணு. ஸ்மார்ட்டா வேலை பண்ணு, SIP ஸ்டார்ட் பண்ணு.
மியூச்சுவல் ஃபண்ட் முதலீடுகள் சந்தை அபாயங்களுக்கு உட்பட்டவை. முதலீடு செய்யும் முன்பு திட்டம் சார்ந்த ஆவணங்களை கவனமாக படிக்கவும்.
Carefully. Hello, everyone. Good evening, and welcome to the program on Decoding an Ideal Investor, jointly organized by ICICI Prudential Mutual Fund and the Hindu Business Line. Idealism and investing, when put together, is an oxymoron at most times. This is because investors are usually swayed more by sentiments than by logic. When the heart takes over the mind, model behavior takes a backseat. Starting early, understanding the product and its risk return proposition, setting goals, being patient, and avoiding the market traps are some of the ideals that investors can strive to follow. To discuss all these points and much more, we have with us today Mr. Aniruddha Chowdhury, Head Retail Sales, ICICI Prudential Asset Management Company. Mr. Aniruddha is a chartered accountant and a cost accountant by qualification. He has been associated with ICICI Prudential AMC for over a decade now, with a total work experience of about 17 years in the banking and financial services space. Thank you, sir, for joining us this evening.
Thank you, Vardhini.
Let's get started on the discussion right away, sir, without wasting much time.
Sure.
So one of the earliest and the time-tested rules for an ideal investor is beginning the investment early in life. So why does this early start assume significance, and how early should one start?
So thank you once again to all the participants, and thank you, Vardhini, for asking this question. I think the best answer is as soon as possible. I will just show you few, or I think it will be easier for the participants also to understand that why I am asking about early. So if you just think about the compounding, and I think Albert Einstein, the renowned scientist, had said that compound interest is the eighth wonder of the world. The best thing is, the more you give time to your investment, automatically the growth of the investment happens in a much, much better rate because of that compounding. The power of compounding is too powerful. So a 10% increase in a 25-year is not a return of 250%. It is actually 985%. So 100 rupees becomes 985 rupees. Now, one who understands and one who keeps money into that particular investment, in the long term, he gains. And the one who does not, he pays for it. So I think I will be the happiest person when in India, and if I think about the lineage, Indians are a good saver. So they save. The only thing is this, I think saving and investment is required, and how fast, how early. So when a child is born, maybe at the time of Namkaran, at that point of time, if anybody starts his investment, I think with 20-25 years, he will be getting a very good experience. And that's the early which I will think of. So whenever a person is thinking about investment, I will again suggest that it's not my word, it's Warren Buffett, one of the best investor and the largest investor in the world, that do not save what is left after spending, because in this consumerism, there is nothing left. If you think about that, I will spend everything and then I will save, there will nothing be left. So it's important that spend what is left after saving. So start early. And I think it's important that you think about first investment, first saving, and then only you can think about any other expenditure.
Okay. So you mentioned that we can start saving right away from when the child is born. Typically young people, they start saving in right earnest when they probably start working. So at this time, they are faced with a dilemma. The thing is, their income levels is also small, and they may also be taking on, they may have some routine expenses, and they may also be taking on some kind of EMI payments or some such thing. So this way, the spending is in fact becomes fixed because it becomes a recurring spending. So what proportion of their income, ideally they should start saving, and how should it grow over the years?
Yes, I will again repeat the quote of Warren Buffett, that do not save what is left after spending, but spend what is left after saving. I think
Okay.
that's the most important thing. So
Okay.
there are thumb rules. There are thumb rules that what is the equity investment, total 100 minus the age, etc. But I think with the time going and the more complexity coming into the system, I think when they start their service or when they start earning, at that point of time, the moment if they think about saving at least 30 to 40% of their income, and again I will say it's not saving first, and then it has to be transformed into investing. I think that will be the best thing, because at that point of time they will not have much of liabilities, and as I have shown that in the long run, the CAGR, the compounding, that's the art, and that thing grows like anything. So maybe after 20-25 years, they will be getting a very good corpus, which will be much helpful for them to take or to become financially much stable and have a financial freedom.
Okay. So, but the thing is, even as many investors, like you say, if they listen to you and they start investing early, sometimes people tend to lose their way in between. Like, some kind of behavioral tendencies which are typical of investors, which take them away from the right path. So, having been in this field since, the global financial crisis, and having seen some markets ups and downs in the last 10 years, what are these kind of behavior that you have seen in investors, and how investors can be wary and avoid such pitfalls?
I think it's a very interesting question. And behavioral finance, I think that's a very vast chapter, a very vast subject. And I think the moment, so investing is actually control of that particular behavior. The moment a person controls and being calm and understands their biases, I think he or she becomes a better investor. The first thing one have to think about, save as a pessimist and invest as an optimist. The moment one does it, automatically it helps in his overall investment avenue. I will share a few of the, again, visuals, I think, which will help all the investors to understand that actually what is required and actually how they behave. And it's, again, I'm saying it's biases. So don't think that you are the only investor who behaves in this way. There is a huge number of investors who behaves, and I will also try to share that what according to us will be helpful for you to overcome those biases. So again, Warren Buffett's beautiful quote that be fearful when others are greedy, but be greedy when others are fearful. Intelligent investors will be doing in the same way. But frankly speaking, what actually happens is exactly the opposite. Now, this is what actually happens. So when there is a sell, and maybe the actual word was something, it was something like Excel, which somebody's hard at sell, and everybody then starts sells. And whenever there is a buy, everybody starts buying. Whenever the market goes up, everybody thinks that it will be like it will go on like that. And when the market actually crashes, I'm talking about whether it is equity, whether it is debt, whether it is real estate, any asset class, at that point of time, maybe that will be an opportune time to invest. But people or investors, general investor, actually thinks on the different way. And that's why what we have seen, that the investment return might be too good. So I can give you some very good statistics that 40 years ago, like 79 2000 1st April 1979, the index actually started with 100 rupees, and the Sensex is now at around 38,000 in around 31st August. So Sensex has given a very good return, more than 15% CAGR return. The only thing is this: how many investors have got that return? Because in between there will be lots of ups and downs. At that point of time, instead of staying invested, maybe they have gone out, and maybe they have invested at a wrong point of time. So again, few data that how the two things, greed and fear, actually ensures that at the wrong point of time, we take the wrong decision. And if we can understand those investment biases, I think it will be much easier for us to be invested and get a much better experience. So again, few data point, how the investors have behaved. So around 2005 to 2007, the infrastructure category was the most sought after category. It gave a very good return. And what we have seen, it's just the AUM just got ballooned. each and every investor, whether that investor risk appetite is okay for that type of investment or not, but they invested into this particular segment. And from 2007 to 2010, it has a negative experience. So again, at that point of time, maybe the opposite thing was required. Maybe at that point of time, one should have booked profit, come out of that. But it's like greed, that greed takes care. The same thing when fear happens. So January to December 2013, if I think about the equity market, it was not a very good experience for those investors. The past return was not good. But at that point of time, if anybody have invested from 2013 December to December 2019, the next 6 years was a beautiful run, and they have got a 85% return. But at that point of time, if I see, there was a huge erosion of the equity AUM. So the investors have just gone out. At that point of time, maybe they have to invest more. The same thing happens again and again. Again, small cap example. I think it's a recent example which one can think about. 2006 to 2017, the AUM grew like anything. The most inflow has come in 2017. The small cap category has got huge AUM. But if you think about, or if you see about the return about to December 2017 to 2018, it's a negative return. So again, the same story again and again it has happened. So what I actually think about, it's like the Mahabharata, the lesson we have learned from Abhimanyu. So Abhimanyu was brave, but he was a tragic hero. As an unborn child, he learned the knowledge that how to enter into a Chakravyuh, but how to come out of that, that was not known to him. So I think for an investor, it's very important that always buy low, but it's as important as buy low to sell high. Is it easy? No, it's not easy. Because at that point of time, when I'm saying sell high, the past return will be too good. His portfolio will be the best of the best portfolio. At that point of time, taking, I think the decision of exit is too difficult. So in mutual fund, there are ways and means. So there are category like balance advantage or dynamic asset allocation category, where the fund takes care of that. So it allocates between equity and debt. And as I have stated that buy low, sell high, it actually goes through that particular cycle. I think it's important to understand one's biases. Once you understand your biases, Daniel Kahneman, he's a Nobel laureate and very highly regarded economist who has done a lot of research on behavioral economics. What he says, that biases are important, and biases, it's not easy to change your biases. So the biases will be there. These type of biases will always be there in the market. It's very good if you can understand your biases and if you can act accordingly. But there are ways and means, and what we think that this is a way where you can actually go through this ups and downs of the market and actually take your call, and the fund itself will ensure that you buy low and sell high. I think that will be the mantra of any investor with which he can gain a much better experience in this investment.
Okay, that was a good explanation on how investor behavior tends to be and exactly what they should avoid. Yeah. So another very important thing, probably the primary thing for any investor or somebody whom you call an ideal investor, is to invest with a goal. So how important is goal setting to the entire process of investing, and can mutual funds be used for goal-based investing?
A very interesting question, and I think very important question. So whenever, in fact, I will ask every participant to think about why they have started an investment. There has to be a goal. Without a goal, if they're just invested for maybe only for return perspective, and that also a gratification which has to be in a very short term, I think they will not have a very good experience. So for this, I think it's important to understand that what's your goal is. Again, I will go to our own Puranas. Again, it's a very, I think everybody knows this particular example. So when Arjuna was asked to think about and to actually think about the bird's eye, he focused, and his determination was so important that he actually was not seeing anything. The same way, I think in financial goal, first one has to think about what his or her goal is. It may be a child marriage, it may be a child education, it may be retirement, it may be anything. In a short term also, it may be after 3 months, he has to put money for some school admission expenses. It might be any of these goals, either short term or long term. But whenever that goal is being set, then he or she has to think about where to invest. There will be avenues where he can invest in a long term. There might be avenues where it can be invested for a short term investment. So the moment again he thinks about the goal and he invests, then he has to think long term, if that goal is a long term goal. So I'm just taking an example. I think huge number of our citizens will be having a goal or having a requirement of a better retirement life. And nowadays, our life expectancy has increased. So automatically, I think that's a very important thing one should plan of. The moment you think about that particular goal and you think about your way of investment, maybe a systematic investment plan, which we always say a very good way of investment, a very disciplined way of investment, then you think about that long-term goal. In between, there will be crises, there will be opportunities, there will be a good year, there will be a lot of these ups and downs. But what you have seen in this particular chart, at the end of the day, if you have put your goal and if you are in long term and you have invested in a disciplined way, I think you will be having a very good experience. If possible, I will also suggest go through this book, Nudge. It's again, so I am a very fond of behavioral economics, because at the end of the day, I think investment is just managing your behavior and understanding your biases. So the book is being written by Thaler and Sunstein. Dr. Thaler is again a big name in behavioral economics. He is again a Nobel laureate. What he says that how you can make saving automatic, whatever good thing. So one thing we have to understand, that a human being is not a rational person. So we are not rational. We think ourselves rational, but we are not rational as per this particular book. So at a different point of time for any decision making, first you have to know your biases, and then a little bit of nudge is required. So can you make your saving automatic? Can you make your investment automatic? I think that will help. So systematic investment plan, why I am too fond of this particular feature, because it's again an automatic investment. In this book, he says, save for tomorrow. It's too important. I think one thing which we have learned from 2020 is a humbling experience, that why thinking and protecting for future is important. Please save for tomorrow. That is too important thing. And he again gives an example of a famous song, The Gambler, by Kenny Rogers. A very good song, a melodious song. But in that particular song, it states a very important thing about investment. You never count your money when you are sitting at the table. There will be time enough for counting when the dealing is done. So in between that journey of reaching your goal, don't count your money. Think about long term. I think the moment you think about long term, it will be much, much better. You will be able to achieve your goal. So I think one, a long-term investment, having a goal-based investment, and then follow that in a disciplined way, and thinking about that long term, in between, not to think about the ups and downs, will be helpful for any investor.
So one of the factors in this goal-based investing is also everyone is worried about what is the ideal return. Like an ideal investor, there is also an ideal return number in everybody's minds. So when you typically say it's planning for your children's marriage in future or for your retirement in future, it is about say 20, or child's higher education, it is at least 15, 20 years down the line. So, what would you have to say to investors about the return expectations on goal-based planning?
Again, a very, I think, pertinent question. And the first thing which comes, and in India, kitna milega? So I think that's the question which comes to everybody's mind. So I will answer it in a different way. See, first thing in investment journey, the goalpost changes. And in the goal, when I'm saying the goalpost changes, ultimately what we are doing. So if you are investing into, say, I'm just giving an example in equity, you are investing into this country's GDP, majorly into a nominal GDP of that particular country is the base for your investment. Now I can give you the past experiences, what I have stated, that 1st April 79, the index started, Sensex started with 100 rupees, and now 31st August, the Sensex value is 38,628 to be precise. Return 15% plus CAGR plus dividend. But don't go by that particular return. Past return is not going to happen in future, because at that particular point, the nominal GDP growth, and then you have to add the inflation, was more or less like that. The same way, in the current scenario also, you have to think about what is the future GDP growth, or the real GDP growth is going to be. The real GDP growth, if you think about, it's going to be 5-6%. Take that particular figure, whatever you think about. So if you are not okay with a 6%, if you are thinking that it can grow by only 4 or 4.5%, whatever figure you can think of, take that particular figure and then add an inflation, because nominal GDP will be real GDP plus inflation. The moment you add that inflation, again, you have a different way of thinking about inflation. You can think about inflation of 6-7%. You think about inflation of 2-3%, whatever you think about. You add these 2%, and I think that will give you a little bit of ballpark figure of what is your expectation. But again, this is a long-term thing. This is not a 1 year, 2 year. There will be a year where there will be a dip in return. There will be a year where there will be a much better experience. Don't be too happy with that much better experience, and don't be too sad about that dip. In the long run, typically, the expectation should be your nominal GDP plus minus. That's the expectation you should have. I will suggest that one, please think about the risk-free return which you are getting in this country. So typically a traditional investment, or to be very precise on an investment term, it will be a government security. But on a very normal way of thinking is a risk-free return which you can get in a traditional investment. And if you are beating that particular investment return in the long run, I think you should be happy. And on a tax adjusted basis, on a 5 to 7 years basis, if you are beating that particular thing, I think you are a better investor than others.
So this point on inflation is quite interesting, because generally, if I, for the audience, if I have to put it in perspective, it's like a 25-year-old today deciding that 1 crore is enough for his retirement. Today 1 crore is a big number, but he is only 25 and he has probably another 35 years to retire before he retires. So at that day, that value of 1 crore, the value of 1 crore on that day is not the same as it is today. So that is another way of looking at it, isn't it? Which is why people should factor in inflation into their planning for the future.
100%, and it is one of the most important. So I state it in a very again colloquial way. It is one of the big asura which is going to take care of your future planning. So please plan accordingly. I will again just share you a few visuals. I think inflation will eat up your money. So how it works? So again, an example only. Suppose if you have kept 50,000 rupees in a box, and that's why I always say that saving and investment is two different things. So in our childhood or in different way, we have seen that gulak, or the money which we used to keep in a particular box. Now that money, suppose, is 50,000. After 10 years, if the inflation is assumed to be at 6%, it comes down to 27,919. After 25 years, it will be around 11,600. Now that's the way. So the money power comes down because of that inflation. So as Vardhini rightly stated, that at this point of time, if you think that if you are planning that at this point of time, 1 crore is a number which is okay for your lifestyle, maybe after 20 years, 15 years, 10 years, that 1 crore requirement will be much, much more. And that's why whenever you are thinking of planning, please keep this inflation into account. The moment you keep inflation in account, you will be able to plan it in a much better way.
That's really helpful, sir. Thank you. Another pillar probably of, of the definition for an ideal investor is also an investor who does proper asset allocation. So don't put all your eggs in one basket is an often heard phrase. but most investors don't consciously diversify their holdings. So what would you want to tell them?
I think again, what data point states that 91% of the return actually comes from proper asset allocation. But typically we tend to think differently. And I think again, the biases comes. So when you are thinking about investment, please think about asset allocation. One, two, think about your total portfolio. So when I'm saying total portfolio, please, my suggestion is give some time to your investment. It is an important, serious discussion and decision. If there is any financial advisor who can advise you, it will be too good, because you will also be handholded by an expert. Now, again, coming to asset allocation, I will just show you how important that asset allocation is. So suppose if an investor has invested only into equity because he has heard equity is too good and he has invested only into equity, think about the year of 2018, 5% return. Think about the year of 2011, 24% negative return. Think about the year of 2008, 52% halved. Now, how many of the investors can actually go through that 2008 cycle? Now, think of another investor who has invested money into equity, who has invested money into debt, who has invested money into gold, which is also an important asset class as far as asset allocation is concerned. And if you can just see this particular chart, the moment on that particular year, 2088, when equity has given a return of negative 52%, the debt has given a return of 9.5%, which is quite good. Gold has given a return of around 6%, which is again quite decent. The moment you have this asset allocation, you will be having a much better good night's sleep. I think that's important. And in the long run, you will gain. So typically what an investor's expectation is. So Vardhini asked this question, ki kitna return? So I'm just giving a hypothetical expectation return figure. Please don't think that this is a return which I am stating at any way. But when a person says that, okay, in a 5-7 years period, you will get a 12%, in his brain, he thinks about every year 12, 12, 12, 12, he will get. But that's not the case which actually happens. The reality is maybe in year 1, he gets 8%. In year 2, he gets a negative 14%. Now on that particular year, whether he stays invested or not, that's the question mark. And the best thing is to have an asset allocation. The moment you have an asset allocation, automatically your journey into this system becomes much, much better. So again, an example, suppose 2010 to 2019, a long period, 9 years period. If an investor has invested equity and debt 50-50, 50% equity, 50% debt. I am not doing any allocation, nothing. So it is a very static type of investment, which I am saying just for an example purpose. Now think of those years, 2011, equity gave a return of minus 25%. With a 50-50 allocation, he gets a return of minus 3%. At the end of the day, I think his journey, his experience will be much, much superior than any of one particular asset class. So my earnest request is, please have an asset allocation. It's easy to state, but it's not easy to follow, because at different point of time, this is a static which I have stated, but at different point of time, when there is a huge return in a one asset class, you also have to book profit, which I have stated with an example of Abhimanyu. So there are ways and means. There are segments like dynamic asset allocation funds, the segment which is there, where automatically this changes happens. So I think for a majority of investors, this type of investment might help, one, asset allocation wise, as well as changing their asset as per the return of that particular asset class.
Yeah. So as you rightly said, it's probably easier said than done, and which is why I think you earlier pointed out that we should use some financial planners or advisors for this. But mutual fund products, mutual funds also have asset allocation funds as one of their product offerings. So, how would you distinguish between asset allocation funds and self asset allocation by investors?
So again, what I have stated, that it's easy to state, but it's too tough to practice, because there will be biases, there will be different nudges which will be coming from different ways. And in this current world, there will be WhatsApp, there will be a lot of information which will be coming to you. and there will be a lot of pessimism, risk. So there will be greed and there will be fear. With that particular things in mind, it's too difficult to have an asset allocation, which I have stated, which see, in fact, when you see this particular slide, when you think logically, it becomes too simple. Now, this dynamic asset allocation type of funds in every, as a whole, different mutual funds will be having, this particular segment becomes much, much easier for an investor. Two way. One, the emotion is being taken care of because he is not now managing. The fund manager is managing that equity and debt, different ways, different level, at different level, what will be the percentages. Two, at the end of the day, his overall experience will be much better, what I have shown you just now, when there is an asset allocation, than a one particular asset if he has invested. The third thing, which is very important, is the taxation part. So when I am an investor and I am investing on my own in a particular asset class and I have to book profit, there are taxation also, which is very important when I'm thinking about the total return. Within mutual fund, when the debt and equity allocation is being changed, there is no taxation which is coming to that investor's hand. At the end of the day, if he stays invested for 9, 10, 11, 12 years, in between, whatever changes, whatever asset allocation changes is happening within that particular fund, he is not taxed. So that's a big advantage for any investor who is investing into this type of dynamic asset allocation fund. I think all these 3 points will be too important for any investor. And that's why I'm saying 90% of, or the majority of the portfolio, if any investor puts money into these type of funds, these type of categories, will be much, much beneficial.
Okay. It's quite informative, sir. So I think like in the last 20-25 minutes, we have discussed the broad and most important tenets for an ideal investor, which is starting early, not exhibiting behavioral biases, setting goals, and following asset allocation. Another important trap for investors is investing without understanding the product. You know, you quoted Warren Buffett for other reasons. I thought I could quote him also here. Uh, with reference to stocks, he always said, never invest in a business that you don't understand. This applies to products as well, isn't it? So how can investors increase awareness before they choose products?
So it's too important. First, it's a serious thing. You're managing your investment, because when you are managing your investment, you are actually trying to become financially much stable, or having your financial freedom in future, or achieving some particular financial goal. If so, that's why it's too important. It's serious, and that's why it's important also to have an advisor or somebody who is quite expert into this particular field. Now, coming to say an investment in equity, I'm just giving an example of equity investment. Now, what actually equity investment is? Now, equity investment is, if you are investing in equity of a particular company, you are actually being an owner of that particular company. You are actually a part owner in that company. Now, when you are becoming a part owner into that particular company, before being a part owner of that company, you should also understand that company itself. You should understand their balance sheet. You should understand that in which particular field that company is working, what are the pros, what are the risks, everything. Now, is it possible for a retail investor, or for myself, if I think about myself, to check each and every investment, each and every company? And for that, mutual fund becomes a very good tool, where there is a professional fund manager, there is an investment team, which actually goes through each of these things in details. And at the end of the day, after checking everything, they invest, and you become a part of that particular investment if you are investing into a mutual fund. One, you should understand about that mutual fund product. I think our regulator SEBI has done a very wonderful job, where they have created segments, and they have always pushed to create a true to label. So if it is a large cap fund, it will be investing into large cap. If it is a debt investment, if it is an accrual category, it will be investing into accrual type of investment. So they have created that segment, which will be helpful for an investor to understand that where they are investing. After that, please understand that particular fund philosophy as well, and then invest for long term. My suggestion will be, if possible, take help of a financial advisor or an expert who can also guide you and ask as many questions as possible. But after that, when you are thinking of taking a particular decision, please stick to that decision. And when you are thinking of all these investment queries, or you're asking all those queries, please don't see the past performance, because that's a rare view mirror. So when you are driving a car, definitely you think you will not be able to drive if you always see the rear view mirror. So think of the future, think about what is going to happen, think about your goal, think about asset allocation, and then you invest. I think if you follow all these processes, you will be having a much better experience.
Okay. Also related, investors don't really, when they look at the returns, they tend to forget the risk they have to take to achieve the returns. So idealism in investing is also about choosing the product according to the risk appetite and not getting lured by the returns alone, isn't it? So
Correct. Very, very well said. I think it's always important to understand the risk adjusted return. So don't think about only the return. The risk adjusted return is the most important thing. Think about your requirement, your risk appetite. And again, the goalpost changes. So what happens whenever you are seeing, or whenever everybody is optimistic, you may think that you can take a lot of risk. It might not be. So think in the long run, whether you require to take that type of risk, whether you require that type of return. If not, avoid that. I think understanding your biases, understanding your risk appetite, and then investing into those investment tool or asset classes, having a proper asset allocation will help you. I will again repeat, to manage your risk, asset allocation is too important, and each asset class is important. When I'm saying asset allocation, it will be equity, debt, gold, every asset class, maybe real estate, which is, I am not a expert on that, but every asset class will be important in your asset allocation journey. I think the moment you do that asset allocation, you will be able to manage your risk in a much better way.
So, ideal investors also invest according to their age. Is there a relationship between age and the kind of investing that people should be doing? Because we don't want somebody who is retired and has his retirement coppers in his hand entirely going and investing in probably equities. So, investors ideally should also connect their age with the investment they are getting into.
Correct. So, in fact, there is a very simple thumb rule: 100 minus your age should be your equity investment. Again, I am not a propagator of that particular rule. I am not saying that that's the exact rule which you should follow. I think you have to think about that as your age progresses, and if you don't want to take any risk, you have to increase your debt investment, and you have to maybe decrease your equity investment. Again, you can take help of dynamic asset allocation type of funds, where there will be a mix of equity and debt, but each of these investment technique is important. So in a cricket field, I think sixers are also important. Ones and twos are again too important. So both equity and debt is important. But what you rightly stated, that if I am a retired person, I don't want to take up much of risk, and maybe I will require a cash flow, then I maybe avoid taking too much of risk into a sectoral type of fund or a pure equity type of fund. Maybe I will be investing more into a hybrid or into a debt fund, and I will go for a systematic withdrawal which will provide me a cash flow. So I think increasing the hybrid will help me in a much better way.
Okay. So I thought I'll ask you the last question before we move forward. Investors generally don't think of emergency corpus. They don't think of maintaining an emergency corpus before making their investments or before spending on other things. Can mutual funds help in building emergency corpus?
I fully agree. I think it's too important. And again, I will repeat that 2020 is a humbling year, where it has actually taught us thinking about all these things. So emergency corpus is too important. In mutual fund also, one can have that emergency corpus, and I will suggest you should have. So there are segments like liquid fund, where you can put money for emergency purpose, and at any point of time, if you require, you can actually think of redeeming that particular money. It is not related to any equity market, and at a T+1 on a working day basis, you will be able to get that money back. So I think emergency corpus, keeping an emergency corpus is important. So when you are thinking about your financial goal, I think this will also be an important thing to understand, that in your overall corpus, you should have something for your emergency, where maybe for medical purpose, maybe for any other exigency, if there is any requirement, you can take help of that.
Okay. That was a very good conversation that we had, sir. We have a lot of audience writing in with their questions. Before that, I thought we will play the compliance slides right now.
Right.
So this is about nomination, why it is important and when you can make it. This is about know your customer norms. If you have to invest in mutual funds, you would have to complete your KYC. You need your identity proof and your address proof. And be informed, which we just talked about. Investor awareness, invest only with SEBI registered mutual funds. And investors, if you have any complaints, you can always write to the email or call us on this number there. SEBI also has a grievance redressal system. And this, I'm sure everyone will be familiar. Mutual fund investments are subject to market risks. Should read the scheme documents carefully before investing. SEBI is also cautioning investors. So look before you leap. So we have a lot of questions from the audience. I think you would like to know their mood after listening to the conversation that happened here. From the very first conversation that we had on starting early, you told us about the power of compounding. So we have two questions actually on compounding. One, Mr. Golak is keen to know how compounding happens in a mutual fund. He says he knows that if he invests in a cumulative fixed deposit, he is aware of the compounding, but how does it happen in a mutual fund?
So the same way, in fact, what happens when you are investing into a mutual fund, suppose if you have invested 5,000 rupees, that 5,000 rupees becomes, I'm just taking an example of 5,100. The next year you are getting a return, or the total, your corpus becomes 5,100. Then on 5,100, your return will start. So whenever your corpus is increasing, you are getting the return on that increased corpus. And that's why that compounding helps. Again, I will just show you the same chart. I think that will give you an understanding that how the magic of compounding helps. So again, think about an investor who has started investment of 100 rupee, and for just example purpose, we have taken a 10% growth. Now on the 20th year, his total corpus becomes 612, but on the 25th year, it is 985. So from 20th to 25th, just think about the growth which he gets. So compounding always helps, especially on the later part of your investment journey. Again, I will give an example of Warren Buffett. So if I think about Warren Buffett's investment journey, his age is now 90 years, and he is around 90 billion worth at this point of time, his investment. but 96% of his investment has actually come after 50 years of his age. So that's the power of compounding. The more you stay invested, I think you will be able to get much better return. So it's again, what Einstein said is, I think it's the eighth wonder of the world. And I will urge you, please take advantage of this. So in mutual fund, you get the advantage of compounding.
Okay. There's also another question on this. Recently, on July 1st, we had, the RBI bonds, which investment products which were announced. So somebody says it has only a payout option. So how will I, when you have more and more safe products with this kind of a option which doesn't allow them, to accumulate. So how will they benefit from the power of compounding?
So again, I think about your asset allocation. So the instrument which you have stated is a very powerful instrument. It's good to have your investment into that powerful instrument as well. It's give you a very good experience. But whether you want to keep 100% of that in that type of investment, maybe you should think about why not diversify. I think Vardhini have stated in a very simple way that don't keep all your eggs in one basket. The same way, why not diversify it, keep something into maybe a equity, diversified equity mutual fund, keep something into a hybrid type of equity mutual fund, and create an SIP corpus as well. I think SIP, we think it a very simple thing, but it's a too powerful instrument, and think it for a long term. The moment you put money into SIP, I think the power of compounding will be too important for you, and it will give you a very good experience, especially on the longer term. So have your SIP for 15 years, 20 years, and then I'm sure if you start your SIP into any of the funds, any of the mutual fund, I think we will be the happiest person, because at least after 15 years, 20 years, you will remember that the power of compounding has created so much of wealth in your own corpus.
Okay. That was a question by one Mr. Vijay Kumar. So following that, we have two important questions, but unfortunately they are anonymous questions. We spoke a lot about goal-based investing. So these two questions are related to that. So one of them is asking us, what is a good estimate of long-term inflation?
So again, you can take any of the estimate which you think is logical. A 6%, 5% inflation estimate is good enough to take, but it changes. So the goalpost changes. See, the beauty of investment is the goalpost changes. The goalpost changes as far as the economy. The goalpost changes as far as the overall scenario is concerned. Now, we are in a very beautiful country and a beautiful, I think we are very blessed. Typically, if I think about economic growth comes from one, if there is a population growth, and if there is a productivity growth. So two things are important. One is productivity, and the second thing is population is also important. So there has to be a demographic advantage. Now, if I think about this country, if I think about our country, India, we are blessed to have a country which is a very young country. So average age 28, 30. That's a very good demographic condition which we are having. Second, we also have a greater productivity. So that also helps. So that also helps into our overall growth. Now, when you are in a growing economy, when you are having such a great advantage of demography, automatically there will be a little bit of inflation. So that's why I have taken an inflation of 6%. But again, there is a RBI target to keep that inflation under control. So you can take a 4% inflation as well, and you can take a 6%, whatever you can think of, you can take it. But one thing is there, on a growing economy, there will be some amount of inflation. As and when we will grow, definitely on a developed economy, the inflation will come down. So from 6%, it will come down to 4% to 3%. But that's the way the economy works.
Okay. So another related anonymous question on goal-based investing is on the number of years which one could be comfortable with. So this person is asking us that he has invested with a 7-year time frame in mind, and he's worried that probably 7 years is not good enough, and he wouldn't be able to meet his goal. So what is your advice for him?
Great, very good question. So first, think about what is your goal. So there might be a very short-term goal. So I'm just giving you few of the practical examples through which I invest as an investor. So if I have to pay my son's school admission fee, maybe after 6 months or 7 months, I have to create a corpus for that. Now that's a very short-term goal. Now for that particular thing, definitely I will invest only into maybe a liquid type of category, or maybe a very short-term category in debt. I will not invest into any of the equity hybrid, nowhere. Okay. Now, if I am having a plan, or if I am having a goal of my retirement, maybe after 15 years, 20 years, then I will be investing into SIP and I will build my corpus for that 17, 20 years. Now, the example which you have stated, you have created a goal for 7 years. So one, please be positive about your, so when you are investing, save as a pessimist. When you are saving, save as a pessimist. When you are investing, invest as an optimist. So at the time of saving as much as possible, thinking that that's the maximum you can save off. And when you are investing, then think about as an optimist. But suppose if I am thinking about my retirement after 15 years, maybe after 12th or 13th year, what I will try to do, I will shift my corpus from equity to an hybrid type of investment, or maybe a debt type of investment. Because on that particular year of 15th, I don't know, there might be some calamity, there might be some different thing which may affect my overall corpus. So what I will suggest, if your goal is maturing on 7th year, better on 5th or 6th year, whatever is your corpus is, maybe that year -1, whatever is your corpus, you can switch it to a hybrid type of investment, which I have stated, that segment which SEBI has stated as balance advantage or a dynamic asset allocation segment. That particular type of category of fund, you can switch your money, or into a debt category of fund where the volatility will be much, much lower. That way you will be in a much better shape when your goal is being achieved, when your time horizon for your goal is being achieved, your corpus will also be with you.
Okay. We have Mr. Anand Bala, who is kind of exhibiting some of the traits of an ideal investor. So he seems to be someone who is booking profits regularly. So he is asking us, at what valuation do you book profits?
So, sir, there is nothing called at what valuation. I'm very happy if you are booking profit and if you're actually going into that buy low and sell high. Again, it all depends upon your risk appetite and what is your requirement. And that's why what we always suggest, that have your own rule, create your boundary, but maintain that boundary. See, why as an AMC, we always propagate that a dynamic asset allocation category is too important for an investor's portfolio, because there is a rule book within which it works. And within that rule book, it will ensure that your equity and debt allocation will be managed. Typically what happens when an investor starts, he creates a rule book, then he starts changing his rule book in between. And that's the problem. So I'm happy if you are booking profit and if you're investing in the same way, like buying low and selling high. The only thing I will suggest you, whatever rule book which you have created, maybe at whatever valuation you want to book profit, whatever valuation you enter, keep that constant, have that discipline in your mind. And there will be time when there will be a lot of greed or fear, which will ensure, or which will nudge you to break that particular discipline. But if you are good enough to ensure your discipline, I think you will be the winner.
Okay. We'll probably take 2 more questions. One is from Mr. Loganathan. Now, he is asking us if a SIP in a single fund is enough to make a dream become a reality. So is he not being an ideal investor by putting all his eggs in one basket, or how is it?
Great. So first thing, you have to understand that what a mutual fund, say, I'm just taking for an example, if when you are thinking about a SIP in one particular fund, equity, pure equity SIP, maybe a large cap, mid cap, small cap, whatever category it is. Now, what that particular fund is having, that particular fund may be having more than 40 stocks. So automatically that fund is diversified. It's not that you are putting all your egg in one particular stock. There are 40 plus stocks already into that particular fund. Now, if you have conviction into that particular fund, if you are okay with the way, the processes at which the fund is being managed, and if you are thinking about long term, it's 100% okay. There is no problem. For diversification, if you want to create diversification, my suggestion will be diversify into a different type of fund. When I'm saying different type of fund, means if you are having an SIP in a large cap, maybe for diversification, you can have an SIP into a maybe a multi cap, maybe a small cap, maybe a mid cap. Then a diversification will happen in a better way.
Okay. So this would be the last question, but it's an interesting question, again, an anonymous question. So this person is asking us why one should invest in a new fund offer and what are the factors you should consider.
So again, so there are queries about new fund offer. So I will say it's up to you whether you want to invest into a new fund or whether you want to invest into an old fund. At the end of the day, you have to check what is the philosophy of that particular fund. What is the segment into the particular fund is working. So whether that particular fund is a thematic fund, whether that particular fund is a large cap fund, whether you are okay with that particular philosophy. If you are okay, then there is no problem into investing into a particular fund, whether it is an NFO, whether it is an ongoing fund. One actually argues that in case of NFO, it's a new offer. So I am not seeing the past performances, but my again humble request, don't check the past performance before investing, because past performance is your rear view mirror. When you are driving, you will definitely will be having accident if you are only driving seeing the rear view. In case of NFO, there are a lot of misconception that I am getting a NAV of 10. It is immaterial. So whether you are getting a NAV of 10 or whether you are entering at a different NAV, it is immaterial. It is the alpha, it is the change of NAV, that's the return which you can get. So if you are not comfortable into investing into an NFO, it's okay, no problem. See the fund and then you invest. If you are okay to invest into that particular philosophy, because all said and done, new fund offer will come with a new philosophy or a new way of investment about that particular fund house. So if you are okay with that particular way of investing, then you should invest into a new fund offer.
Okay. Okay, I think we have discussed enough about what an ideal investor should do and should not do. Hope the participants in this webinar have benefited from all this discussion and hope they will take a right step forward from today. Thank you, sir. Thank you very much for joining
Vardhini, just I will add one sentence and I will request everyone to think about it. I think it's a very simple statement, very powerful statement. At the end of the day, personal finance is more of person than finance. So it is more of your personal view, your personal biases, your personal requirement, your goal, your risk appetite, your investment ways. So it is more of your personal way of investment rather than finance. And the second thing is, it's more of managing your biases. So if you can manage your biases, if you understand your biases, that you have these biases, you have to manage those biases. And if you know your personal requirement and goal, and with that, if you invest, I am sure you will be having a much better experience.
Okay. That sums everything up very well. Thank you very much, sir. Thank you. Thank you to all the participants.
Thank you. Thank you, Vardhini. Thank you all.